Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday, the 29th of March 2020. And this morning we published a video entitled, Why You Should Look Out for the Job Figures This Week. And yesterday we published our Gold and Silver Weekly Update for the week ending the 27th of March. And we've placed links to both of these in the description box below. Now, in recent weeks, much has been made of the meltdown in equity markets. In the past month alone, the Dow Jones Industrial Average Index has fallen almost 15%, and the S&P 500 14%. The Euro Stoxx 50 has fallen by 18%, and the DAX Index by 19%, and the FTSE 100 by just over 16%. Performing somewhat better recently, we've seen the Hang Seng Index fall by 10% and the Nikkei 225 by just over 8% in the past month. The annual figures admittedly do not look that great either, with the Dow Jones down 16.5%, the S&P 500 down 10.3%, and the FTSE 100 down a whopping 24%. Though Brexit and its deliberations and other issues will have had a considerable effect. Now, we are hearing calls all over the internet and YouTube that equities are going to plummet by as much as 80%. And it could be the end of the financial system as we know it. Now, none of us, admittedly, have a crystal ball or are so omniscient that we can predict the future with 100% accuracy. But some of us have lived long enough to encounter a number of significant recessions and stock market declines, only to find that the world recovers from them all in time. Now, this does not help those who need their money today or are on the verge of claiming their pension pots. But taking the long term into account and into view, what we are experiencing is something which happens every 10 years or so. And although the causes may be different, what tends to happen thereafter generally conforms to a certain playbook, with only the timing being somewhat different to the road to recovery. So, we thought we would read two articles recently published in Financial Advisor magazine, a publication for investment professionals and advisors. And these articles give an interesting perspective. Positive in Somber Times by Simon Reed, freelance journalist for the Financial Advisor publication. Article is dated 19th of March 2020. The stock market turmoil is likely to be with us for some time, but I've noticed something really quite positive coming out of it. Those as long in the tooth as me will remember previous market crashes. You will recall that markets have always bounced back on other occasions, although not always that quickly. In fact, the long, slow 50% fall in the FTSE 100 index that began on December the 31st, 1999, lasted 1,167 days. The market did not recover from the collapse that followed the investment madness of the first internet boom until March 2003. I can remember investing in the middle of 2000 when I thought that markets had hit bottom and it was a buying opportunity. How wrong I was. I hung on to my funds for years, hoping to eventually make a profit. I never did because of the high fund management charges back then. It meant that even after the FTSE recovered to the level I had bought in at, which took around 7 years, my funds were still around 40% down. That was simply because I had been charged 5% every year. Now, do not get me wrong. I'm not complaining. I knew the risks and had only invested cash I had to spare. It meant I was happy to sit things out for the ride. But I knew plenty of other people who got caught up in the stock market fever at the end of the 1990s. Many took risks they could not afford and ended up suffering losses that put them into financial difficulties. I can still hear the voice of one friend telling me, I need the money, but I cannot afford to sell when the market is so low. He asks, when will it recover so I can get my money back? I could not tell him when it would recover, although I had no idea it would take 7 long years to reach the same level. But I could tell him that his money was gone. He had exchanged it for some shares which were now worth a lot less. Their actual value was not what he had paid for them, but how much someone was prepared to pay him for them. But that's not fair, he said. It is fair, and it is the basis for all trades and markets. If you buy something to sell, you have to accept that there is a risk of not being able to find a buyer at the price you want. I tried to explain that to him, but he did not really get it. He sold and vowed to stay away from the stock markets forever. I suspect he was not the only person who got burned back then, who swore off investments, and that was a big shame. Seasoned investors expect the occasional knockback. Markets are driven by sentiment, and that means they perform irrationally at times. But over the long term, rewards can be made. The always thoughtful Brian Dennehy of Fund Expert says, "Don't predict the future, just control what you can control." In other words, make sure you have a mixed portfolio with, say, a 10% stop loss on any high-risk investments and a good chunk of your savings in cash. As much as 50%, recommends Mr. Dennehy. He has long warned of a correction of 25 to 30% in stock markets, but recently upgraded that to a risk of falls in the 55% to 80% range. That's not a pleasant thought, but it's not the end of the world, he says. It is essential to recognize the danger and figure out how to respond. He warns of complacency generated by a 40-year bull market when shares have always recovered, but he fears that stock markets are extremely vulnerable to a shock. This that we are experiencing is a massive wake-up call to investors and the financial industry and the media, a large proportion of whom have sleepwalked into the unfolding crisis he warns. I cannot help but agree, but the difference I've noticed during the financial crisis, this financial crisis, is the response of ordinary savers and investors. I've had people buttonhole me in the pub with a cherryish, "My pension's lost 15%. A colleague on a national newspaper updated me on the progress of his stocks and shares ISA, which had shown a 15% gain a few short weeks ago. Now it is down more than 5%. The attitude in 2020 seems to be of resignation rather than anger. The current generation of investors lived through the financial crises of 2008. They understand the nature of risk and accept it as part of investment. And that is the positive that has come out of the current crisis, to my mind. We now have a section of the general public that is a lot more aware of financial matters. That does not mean that losses hurt less, but just that they will not run away and stash their cash under the bed instead. No, like markets, they will bounce back another day. End of article. Article published by James Coney, money editor of The Times and The Sunday Times. Published in Financial Advisor magazine, 19th of March 2020. Make hay while others are losing their heads. Now is the time for financial advisors to prove their worth when the rest of the market is falling apart. Quote, "How are we feeling? Nervous? Calm? A bit sniffly? Or perhaps you're sitting back comfortably knowing that everything has gone exactly as you'd expected? I suspect there are a lot of people out there who are currently very glad they sought the services of a financial advisor. Now is the time to make hay. Advice Community." While others are losing their heads, this is the moment that your skills should shine. As if the market was not feeling a tad weak anyway, and sentiment was fragile enough, along came an all-out standoff between the Russians and the Saudis over the price of oil. That is not a political spat you want to be in the middle of. We may not have known it 10 days ago, but the bulk buying of loo roll and tinned peas was actually a symptom of something much more malign. No, not the overriding fear what was going to spread, but of financial contagion. The negative sentiment about how the country would cope was already giving jitters to the markets. So when the oil price plunged 20%, that was enough to send everything into meltdown. For a few years, investors have been warning that the near 12-year bull run in equities would come to an end. No one thought it would happen like this, though. Rather than the unrelenting run grinding to a halt because of wider economic uncertainty or weak fundamentals in corporates, it was something we never expected. The whole sell-off was met with the predictable panic from ordinary savers asking what they should do. To which the answer is, at least from those who probably diversified or sought the help of an advisor, this is what you planned for. This is why we all build a portfolio of investments, so do nothing. I suspect that will prove difficult to those passive fund loyalists who may suddenly find themselves more exposed to the market than they intended. The advice I heard the most was not to sell. A loss is not a loss unless you turn it into one. Shares have just got cheaper, and besides, now is the time to focus on the long term. Advisors should be reminding clients that they are saving for the long term. That is not 5 years, nor even necessarily 10, but 20 or 30 years. Anyone who began investing 35 years ago has invested through the Great Recession, Black Wednesday, the dot-com crash, and they are still more than 1,800% up, even with today's losses. No one quite knows how long the market turmoil will last. Hopefully, days like Monday, March the 9th will prove rare. Most economists believe we're on the downward part of a market that looks U-shaped. But even they do not know how long this first bit will last before we turn the corner. So this is why good advisors will be highlighting to clients that actually this unexpected turbulence was planned for. If active managers and financial advisors cannot prove their worth when the rest of the market is falling apart, then really there is no hope. End of article. Now, if we set aside the clear plug James Coney makes for the benefits of using a financial advisor, the points he raises are quite valid. If you've invested your assets into a portfolio with a degree of spread and risk profile, then, although in these difficult times their value may have fallen, such falls should be relatively modest. A practical example is one of my pension pots, which had a 50% exposure to equities and 50% invested in a mixture of bonds, gilts, cash, and other low-risk securities. My pension fund, overall, has fallen by just under 15%, which is a lot less than many people's equity portfolios. Am I concerned? No. Am I happy? No. But as mentioned, when I transferred one of my pensions into this managed fund, I did so with my eyes wide open, accepting that last year the fund made an overall gain in excess of 10% after charges, and this year it has fallen by 15%. So, although I am worse off, it's still far less as a percentage spread on, say, purchasing a Silver Eagle coin, even in good times, when there are low premiums. Now, whilst we suspect equity markets to continue to take a hit for a short while ahead, we are also very much aware that a number of professional investors are holding large stockpiles of cash, with a view to re-entering those markets at much lower levels than they were just a couple of months ago. How often have we publicised that Warren Buffett was holding on to quite excessive levels of cash in the latter part of last year and the early part of this year? What do you think that he and other institutional investors will be doing in the months ahead? My pension fund now is currently almost 50% in cash, having sold 25% of its US and UK equity stock a month ago, which is why my losses are not as great as many others. These managers are sitting on high levels of cash, and whilst all of us would love them to invest in gold and silver, causing their prices to skyrocket so we can benefit financially, we suspect that the equity markets will once again be the main depository of these funds. Perhaps not quite yet, and it won't be that long down the road where the headlines will be very different from what they are currently. Later in the week, we shall also discuss why banks are not likely to suffer the systemic risk that they suffered in 2008, and why the pumpers' doom and gloom message may not actually be as accurate as they would lead you to believe. That does not mean there won't be difficult times ahead. For sure there will be. But equally we expect and envisage a degree of normalization in a few months. Thank you so much for listening. If you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they're published. By all means, please express your comments and views below. And also, not forgetting to pop over to our Richard and Greg channel, where every other day we produce a video giving a geopolitical global update. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.